Okay, let's go ahead and run through an example with some temporary difference. Now, if we have an existing temporary difference, that is, one which has already originated, we need to create a deferred tax asset or liability to reflect the effects on our taxes when that difference reverses. Generally speaking, taxes tend to dampen our economic activities or the results of our economic activities. If we have income, taxes reduce it. If we have a loss, then loss carrybacks and carry forwards will offset part of that loss. And it's the same idea with deferred tax assets and liabilities. If we have a receivable from a sale, and that receivable is an asset, and when we collect it, we'll be subject to income taxes. So we need to report a deferred tax liability so that liability, again, offsets or dampens the value of that receivable asset. Similarly, if we estimate and accrue warranty costs as an estimated warranty liability, when those warranty repairs are made, we'll have a tax-deductible expense. Therefore, we need to create a deferred tax asset representing those future tax-deductible expenses and the resultant tax savings as a counterpart to the warranty liability. If we face a 40% tax rate and our receivables or prepaid expenses go up by $100,000 from year 1 to year 2, then our deferred tax liability should go up proportionally by $40,000. Similarly, if our accrued liabilities such as wages, interest, warranties, etc. go up, then our deferred tax asset should go up proportionally. Some firms, when they report their deferred tax assets, they refer to the changes in working capital, current assets minus current liabilities, and tie those to the changes in deferred tax assets and or deferred tax liabilities. Okay, let's go ahead and go through an example with a depreciable asset. Let's assume that on January 1st, 17, ABC Company purchases a depreciable asset for $100,000. It's expected to have a useful life of 5 years with no salvage value. For financial reporting purposes, they're going to use straight line depreciation, while for tax purposes, they'll use an accelerated method, taking depreciation of $40,000, $30,000, $20,000, and $10,000 in years 1 through 4, with zero depreciation in year 5. Let's further assume that ABC faces a 40% tax rate for 2017 and 2018, and that a tax rate of 30% has already been legislated for 2019 and beyond. A visual representation of the differences would be as follows. So we have our 5-year timeline. Financial depreciation is going to be straight line $20,000 per year. And then we have our tax depreciation, and again it was given as $40,000, $30,000, $20,000, and $10,000, nothing in 2021, for a difference in the first year of $20,000. And again, this is going to be the originating difference, and we have to decide whether this is a taxable or a deductible difference. Now we're talking about an expense here, depreciation expense. We're taking $40,000 of depreciation expense for tax purposes, only $20,000 for financial purposes. That means we're taking more depreciation for tax purposes, which means less income for tax purposes, which makes this a deductible difference. And deductible differences traditionally are put in parentheses. Okay, same thing for 2018, a $10,000 deductible difference, zero difference in 2019, and then $10,000 and $20,000 in taxable differences in 2020 and 2021. Again, deductible differences indicated by parentheses, taxable differences not having any parentheses around them. And again, just to sort of have all of our information in one place, we have tax rates of 40% for the first 2 years and 30% thereafter. Now let's go ahead and assume that ABC is going to report taxable income of $100,000 each year. Now in 2017, we have an existing $20,000 deductible difference. Again, it's now the end of 2017. We're sort of at that line between 2017 and 2018 in our table. And we look backwards and say, how much of a cumulative temporary originating difference has already arisen? And well, in 2017, we took a $20,000 deductible difference. When that reverses in the future, in 2020 or 2021, it's going to be taxed at 30%, costing us $6,000. That means that based on the existing originating differences at the end of 2017, we need a deferred tax liability of $6,000 in the deferred tax liability account. Again, that $6,000 is the amount of the existing temporary difference, the $20,000 deductible difference, how much that will cost us when it reverses in the future, being taxed at 30%. So when we record our taxes, we're going to go through a little three-step dance. Again, as before, taxes payable will be our taxable income of $100,000 times the tax rate of 40%. Second, we analyze our future reversing differences and determine that there's a $6,000 deferred tax liability needed. Now, this was our first year, and so we're starting with a zero balance in the deferred tax liability, and so we're going to go ahead and credit deferred tax liability to put that balance on the books. And tax expense is simply a plug figure, the sum of what we paid this year plus or minus the changes in our deferred taxes. So basically, this year we paid $40,000. We saved on our taxes this year by using the accelerated depreciation. Eventually, we're going to, so by saving money on taxes today, that implies we're going to have to pay more in the future. And so again, we paid $40,000 today. We're going to have to pay $6,000 more in the future for a total cost of $46,000. In 2018, we'll do the same thing. We're at that line between 2018 and 2019, and looking to the left, we have cumulative originating deductible differences of $30,000, $20,000 for 2017 plus $10,000 for 2018. When those reverse in the future in 2020 and 2021, they're going to be taxed at 30%. So $30,000 of deductible differences, when they reverse and are taxed at 30%, are going to cost us $9,000. So $9,000 is the desired balance in our deferred tax liability. There's already a $6,000 credit balance in that account, so we're going to have to add $3,000. So again, step 1, taxes payable, taxable income times the tax rate. Step 2, record the changes in our deferred taxes. Step 3, tax expense is a plug figure. Okay, 2019. We still have a cumulative total existing originating difference of $30,000. When those reverse in 20 and 21, they're going to cost us $9,000. Therefore, we need a $9,000 credit balance in the deferred tax liability. That balance already exists, so there are no changes this year in the deferred tax liability. We still have to record this year's taxes payable and this year's tax expense. In 2020, now we're starting to reverse or unwind those existing temporary differences that originated back in 2017 and 2018. At the end of 2020, we still have a net $20,000 originating deductible difference that's going to be reversing in the future in 2021. When that reverses, that's going to trigger a tax bill of $6,000, and so that's the desired balance in the deferred tax liability. We've already got a credit balance of $9,000 in that account, so we have to remove $3,000. So again, taxes payable is always the easy part, taxable income times the tax rate. We go ahead and take away $3,000 from our deferred tax liability, and tax expense is $27,000. Finally, in 2021, our last year, we've now completely unwound or reversed all of the temporary differences. Again, we're at the very right-hand margin of our table. Looking backwards, those differences net out to zero. We had $30,000 in deductible differences in 2017 and 2018. We had $30,000 in taxable differences in 2020 and 2021, so they all net out to zero. Looking to the right in our table from 2021, there's nothing in the future. So there are no future reversing differences. Therefore, we should have no deferred tax asset or liability. We're currently carrying a $6,000 balance in that account, so we have to get rid of that. So again, we're going to go ahead and credit taxes payable, taxable income times the tax rate. We get rid of that remaining deferred tax liability, and tax expense is again a plug figure.